Warren Buffett is a name synonymous with investment success. His company, Berkshire Hathaway, is a testament to his remarkable ability to identify and capitalize on undervalued companies. Buffett's investment philosophy, rooted in value investing principles, has earned him the moniker the Oracle of Omaha and inspired generations of investors worldwide. His approach emphasizes long-term growth, intrinsic value, and the power of patience. Buffett's impact on the world of investing is undeniable. He has consistently outperformed market averages for decades, proving the effectiveness of his value-driven approach. His investment philosophy, characterized by thorough research, a long-term perspective, and a focus on intrinsic value, continues to guide investors seeking long-term financial success. Buffett's ability to identify undervalued companies with strong fundamentals has been instrumental in his success. He focuses on businesses with a durable competitive advantage, often referred to as an economic moat, which allows them to generate consistent profits over time. This approach, combined with his unwavering patience, has made him one of the most successful investors of all time. His influence extends beyond the realm of finance. Buffett is known for his philanthropy, pledging to donate the majority of his wealth to charitable causes. His commitment to giving back further solidifies his legacy as not only a brilliant investor, but also a compassionate humanitarian. Central to Warren Buffett's investment philosophy is the importance of long-term investing. Buffett firmly believes in identifying companies with sustainable growth potential and holding on to those investments for extended periods, often years or even decades. This long-term perspective allows him to ride out market fluctuations and benefit from the compounding effect of returns. Buffett's approach stands in stark contrast to the short-term trading mentality often seen in the market. While many investors chase quick profits, Buffett focuses on the bigger picture, understanding that true wealth is built gradually over time. He seeks out companies with a durable competitive advantage, allowing them to generate consistent profits and weather economic downturns. This long-term perspective is evident in Buffett's investment decisions. He is known for his forever holding period, meaning he is willing to hold on to investments indefinitely as long as the underlying business fundamentals remain strong. This approach requires patience and discipline, but it has proven to be a winning strategy over the long run. By embracing the long game, Buffett avoids the pitfalls of market timing and emotional decision-making. He understands that markets are inherently volatile in the short term, but tend to reflect the true value of businesses over the long term. This unwavering belief in his investment philosophy has been a key driver of his success. One of Warren Buffett's most famous investments, Coca-Cola, exemplifies his strategy of identifying companies with enduring value. In the late 1980s, Buffett recognized the strength of Coca-Cola's brand, its global reach, and its ability to generate consistent cash flow. He saw an opportunity to invest in a company with a durable competitive advantage, one that would continue to thrive for years to come. Buffett's investment in Coca-Cola was not driven by short-term market trends or speculative hype. Instead, he focused on the company's intrinsic value, which he believed was significantly higher than its market price at the time. He understood the power of Coca-Cola's brand recognition, its vast distribution network, and its ability to adapt to changing consumer preferences. Over the decades, Coca-Cola has proven to be a wise investment for Buffett. The company has consistently grown its earnings and dividends, rewarding long-term shareholders like Berkshire Hathaway. This investment highlights Buffett's ability to identify companies with a lasting competitive advantage, capable of generating sustainable returns over the long term. The Coca-Cola example underscores the importance of looking beyond short-term market noise and focusing on the underlying fundamentals of a business. Buffett's investment philosophy emphasizes identifying companies with strong brands, efficient operations, and a history of profitability, characteristics that suggest enduring value. Warren Buffett often refers to the concept of an economic moat when describing the competitive advantages that protect businesses from competitors. A moat, like the protective barrier surrounding a castle, provides a company with a sustainable advantage, allowing it to maintain market share and generate consistent profits. Buffett seeks out companies with wide moats, those with significant barriers to entry that make it difficult for competitors to erode their market position. These moats can take various forms, such as brand recognition, economies of scale, proprietary technology, or regulatory barriers. The wider the moat, the more resilient the business is to competition. Companies with strong moats are better positioned to withstand economic downturns, technological disruptions, and competitive pressures. Their competitive advantages provide a buffer, allowing them to maintain profitability and continue rewarding shareholders over the long term. Identifying companies with durable moats is a cornerstone of Buffett's investment strategy. Investing in companies with wide moats aligns with Buffett's philosophy of seeking long-term value. By focusing on businesses with sustainable competitive advantages, he aims to minimize risk and maximize the potential for long-term capital appreciation. The concept of the economic moat is a powerful tool for investors seeking to identify companies with enduring value. Section 5. The virtue of patience weathering market storms. Patience is an indispensable virtue in Warren Buffett's investment approach. He understands that markets are inherently cyclical, experiencing periods of both exuberance and fear. During times of market turmoil when others panic and sell, Buffett remains calm and collected, often viewing these downturns as opportunities to acquire undervalued assets. Buffett's patience stems from his deep understanding of market psychology and his unwavering belief in his investment philosophy. He recognizes that short-term market fluctuations are often driven by emotion rather than rational analysis. By maintaining a long-term perspective, he avoids making impulsive decisions based on fear or greed. One of Buffett's most famous quotes highlights the importance of patience. "The stock market is a device for transferring money from the impatient to the patient." This quote encapsulates his belief that those who can control their emotions and stay the course during market volatility are more likely to achieve long-term success. Buffett's patience is not simply about waiting passively for investments to appreciate. It also involves being selective in his investment decisions, waiting for the right opportunities to arise, and having the conviction to hold onto those investments even when faced with market pressures. Section 6. Apple and the Power of Time. A case study in patience. Warren Buffett's investment in Apple, a company once considered outside his traditional circle of value stocks, demonstrates the power of patience and the importance of adapting to a changing world. Initially hesitant to invest in technology companies, Buffett recognized Apple's strong brand, loyal customer base, and impressive cash flow generation. Although Apple's stock experienced periods of volatility, Buffett maintained his investment, allowing time for the company's growth story to unfold. Apple's continued innovation, expansion into new markets, and strong financial performance ultimately justified Buffett's patience, turning the investment into one of Berkshire Hathaway's most successful holdings. The Apple investment highlights Buffett's willingness to evolve his investment approach while remaining true to his core principles. Despite his historical preference for companies in more traditional industries, Buffett recognized the transformative nature of technology and the enduring value proposition offered by Apple. This case study underscores the importance of being open-minded, adaptable, and patient in the ever-changing world of investing. While adhering to his fundamental investment philosophy, Buffett demonstrated a willingness to consider companies in new sectors, recognizing that long-term success requires adapting to evolving market dynamics. Section 7. Cultivating Patience. A disciplined approach to investing. Cultivating patience in investing requires a disciplined approach, one that emphasizes long-term thinking, emotional control, and a deep understanding of one's investment goals. It involves resisting the urge to chase short-term market trends and instead, focusing on the underlying value of investments. One key to developing patience is having a well-defined investment plan and sticking to it. This plan should outline investment goals, risk tolerance, and a clear strategy for achieving those goals. Having a plan in place helps investors stay focused and avoid making impulsive decisions based on market noise. Another important aspect of cultivating patience is managing emotions. Fear and greed are powerful forces that can lead to poor investment decisions. By understanding these emotions and developing strategies to manage them, investors can make more rational choices aligned with their long-term goals. Patience in investing also means being selective in choosing investments. Rather than jumping into every investment opportunity, it's crucial to conduct thorough research, understand the underlying business fundamentals, and invest only in companies that align with one's investment philosophy and risk tolerance. Section 8. Applying Buffett's Wisdom, a Path to Financial Success. Warren Buffett's investment philosophy, characterized by its emphasis on long-term investing, patience, and the identification of companies with enduring value, offers valuable lessons for investors of all levels. By embracing these principles, individuals can increase their chances of achieving long-term financial success. One key takeaway is the importance of adopting a long-term perspective. Rather than chasing quick profits, investors should focus on identifying companies with sustainable growth potential and holding on to those investments for extended periods. This approach allows for the power of compounding to work its magic. Another crucial lesson is the significance of patience. Markets are inherently cyclical, and investors must be prepared to weather periods of volatility. By maintaining a long-term outlook and resisting the urge to make impulsive decisions based on fear or greed, investors can stay the course and achieve their financial goals. Finally, investors should strive to identify companies with durable competitive advantages or economic moats. These moats provide a buffer against competition, allowing companies to maintain profitability and reward shareholders over the long term. By focusing on businesses with sustainable competitive advantages, investors can increase their chances of achieving long-term success. For those seeking further insights into Warren Buffett's investment philosophy, his annual letters to Berkshire Hathaway shareholders are a treasure trove of wisdom. Additionally, books such as The Warren Buffett Way by Robert G. Hagstrom provide comprehensive analyses of Buffett's investment strategies and offer practical advice for applying those principles to personal investment portfolios. By studying Buffett's approach and incorporating his key principles into their investment strategies, individuals can increase their chances of achieving long-term financial success.